All right, welcome to the first of its kind, world-changing manufacturers network. Lisa Ryan has her ears to the ground and her heart in the game. Get ongoing education and new connections right here with Lisa and the Manufacturers Network. Buckle your seat, listen, and spread the word. Here's Lisa.
Hey, it's Lisa Ryan. Welcome to the Manufacturers Network podcast. I'm excited to introduce our guest today, Marshall Lebovits. Marshall is president of Asset-Based Funding Solutions, leveraging 35 years of lending experience to assist growing companies with obtaining working capital when too much cash is tied up in receivables and inventory. Marshall, welcome to the show.
Thank you. It's a pleasure to be here.
So share with us a little bit about your background and what led you to doing what you do.
I have 35 years of experience, which means I'm really old and have gray and thinning hair. And I started off working in the corporate finance division of Federal Express Corporation a long time ago, where I worked on both profit and loss statements as well as balance sheet issues. I then made a big move to work in aircraft finance for McDonnell Douglas, and I was financing airplanes around the world. And that led to a career path which included equipment leasing for all size companies, commercial banking with some middle market banks here in Southern California, as well as stints being an advisor to growing businesses. And about 8 years ago, I decided to go back and, in effect, pursue a passion project, which was to help growing businesses who may not have the kind of knowledge I have, the expertise, or the connections to help them make better decisions in terms of how they raised money for their companies in a non-dilutive manner. And 8 years in, I am happy to announce I've funded dozens of companies, and I've helped them grow, and I've helped them raise capital to achieve their dreams without having to give up any of their ownership shares.
Nice. So why is access to working capital such a critical issue for growing businesses?
That's a great question, and I'd like to start by defining what working capital is, just to make sure everybody is working with the same definition. So working capital is really a measure of a company's ability to pay its bills in the near term. And two key factors of working capital are the amount of funds a company has tied up by not quickly collecting their receivables and by not quickly selling their inventory. Now, the reason this is such a critical issue is because any money that you have tied up in receivables and inventory is money that you can't use to grow your business and, at the end of the day, enhance and grow your enterprise value. So that's less money that's available for new product R&D, to expand into new markets, to spend on equipment maintenance, which if you don't maintain your equipment, you'll get declined productivity or increased downtime. It's money that's not available for new equipment, whether for expansion or to accommodate new sales or productivity improvements. So when you have that shortfall because you've tied up too much money in receivables and inventory, you can fund that shortfall in two ways. You can sell equity in your business, which means you're giving up some of your shares, or you can borrow money, which comes at a cost. And so the idea is, how do you manage working capital in a most efficient way to get what you need done for your business without diluting your ownership?
Okay, that makes sense. So then what are some of the biggest misconceptions then about business financing?
So the biggest misconception is if the bank says no, I have nowhere else to turn. But banks say no for a wide variety of reasons that may have little to do with the creditworthiness of the borrower or the attractiveness of that loan. That being said, there are a lot of other funding sources available to small and medium-sized manufacturers, including the SBA, the USDA, private credit, which includes my world of asset-based lenders, as well as a number of other funding solutions. So there's money. You just have to know where to look for it and make sure you get the right money for your needs.
Okay. You already mentioned it that many companies have cash tied up in receivables and inventories. What are some of the strategies that they can use to improve cash flow? And again, without taking on that unnecessary risk or the expense that comes along with getting money.
The first thing I would recommend is that a company manage its receivables and inventory on a regular basis and not just at month end. Somebody needs to be managing those numbers every week, if not in some cases every day. The second thing I would recommend is that a company establish strong written protocols for credit and collections. A slow paying customer is a drag on your profit margin. And the only worse thing than a slow paying customer is one that doesn't pay you at all. And finally, I would make sure that my inventory reporting systems are providing real time information so that you can manage the aging of your inventory as well as the sales velocity of your specific SKUs. Inventory is an incredibly expensive albatross to bear. It takes up costly warehouse space and it consumes cash, and you want to manage it very efficiently.
It's so funny because I'm a huge fan of Shark Tank, and I think I listen to this discussion every week about inventory and when people are just looking for money. Because, yeah, you think, especially when you have lots and lots of SKUs that manufacturers do, it's just figuring out, okay, that what is that right balance? So I think that monitoring that you just said a lot more frequently than once a month would be a really good thing to start implementing.
Absolutely. I've talked to a number of Shark Tank companies, and managing receivables and managing inventory are two of their biggest challenges.
Yeah, without doubt. So, what are some of the factors that business owners should consider when choosing the right type of funding for their company?
Oh, good question. So, the first question I would ask myself as a business owner is, why do I need the funding? Is it to cover losses? Is it for working capital? Or is it to invest in business expansion? I would then ask, do I need the money short term or long term, which could dictate what types of funding solutions that you want to pursue. Then I would say, how does my credit profile look to a lender? How strong is the cash flow? How strong is my balance sheet? What collateral am I offering to the lender, if any? One of the things I've learned, it's really hard to monetize inventory and unique or rapid obsolescence equipment. Next, I would say, who owns my company? How is it legally structured? And how will I respond if I'm asked for a personal guarantee, which a lot of business owners in that small to medium size space don't want to offer. And there are ways around that, but it really comes to knowing the answers to the prior questions. And I think the last question I would want to consider is, what are my interest rate expectations and how do those compare to market rates for what my risk profile is today? Those 5 questions are all things that I would consider in understanding how to choose the right type of funding for my business.
With all those questions, then, what are some of the most common mistakes that businesses are making seeking finances, and how can they avoid them? Obviously, starting with those 5 questions is a good thing to do, but they're probably making lots of more mistakes before then.
Absolutely. And so, assuming they've asked those questions, and those answers may vary based on the size of business they're in, as well as their industry and what current market conditions are. But here's some advice, things not to do, which is don't delay the search. Start early and talk to the lenders who are a best fit for you today, not who you think you're going to be in 12 months, right? That's where they're going to make the credit decision. It's not typically based on projections. They're mostly looking at historical results. So who are you today? Who's the best lender? Start early. Then I would say, don't put all your lender eggs in one basket, because an old saying is, if you borrow a lot of money, I'm sorry, if you borrow a little money, you have a lender. If you borrow a lot of money, you've got a partner. And part of what I like my clients to do is make sure that they're not getting all of their money from one source. Because then if something goes wrong, you've truly got somebody who could significantly impact how you run your business, if not whether your business continues. One of the other things I would tell companies is while you shouldn't ignore it, you shouldn't solely focus on who is offering the cheapest money. Because what if there are covenants that they're offering in return for that money that dictate how you operate your business? Or the lender has looked at it, and in order to get to that cheap rate, they have had to make a lot of optimistic assumptions about who you are and how you're going to perform. If the least little bit thing goes wrong, you might get called for a conversation and it might not end well. The other things I would consider is how you talk to the lender. A lender wants to know how they're going to get repaid. And if it's a bank, they also want to know what other services they can sell you, as opposed to an investor who wants to know how you're going to make them rich. Right? So if you don't understand that nuance, you might be talking in the wrong way to a prospective lender. You need to tell a lender, here's the cash flow I'm going to have available to service my debt. Here's the collateral I'm going to offer you. Here's the strength of my balance sheet. Here's what could go wrong. And here's how I'm going to protect you. Here's the upside, if you will, in how things might accidentally not work out just as you had planned them. So those are all important, as well as another mistake, which is deadly, which is your financial reports aren't accurate. They're not readily available in the form the lender needs. I'm working with the client right now, and that's exactly what we're doing. Before we even approach a lender, we want all the historical information available now so that it's ready to go. And as we're looking at projections, we want to see what's wrong with those projections. Where are the numbers off? Did somebody make a bad entry? Did they double copy a column over? Everything needs to be right, because the minute they find the mistake is the minute your credibility is lessened and they may lose interest in the funding opportunity. Those are some of the common mistakes and how I advise my clients to work around them to avoid them.
That's interesting because I have a friend of mine that they have a real estate investing business. And one of the things that they've been successfully able to do over the years is they've built really strong relationships with their lenders, because as the market goes up and down and money goes up and down. So what are you seeing? Because you said on one hand not to put your eggs in all in one basket, but on the other hand too, how are you recommending that people build those relationships with the lenders so that the lenders basically know and trust them, and sometimes will take a chance on them when if they didn't know the person, maybe they wouldn't?
That's an interesting question. And as a former banker who used to cold call chief financial officers, I have a strong opinion about that, because often the answer would be, we've got who we need, go away, don't bother me, and don't call here again. And my feeling was, you never know how the world is going to change. Your business prospects could change, that your existing banker's appetite could change for a wide variety of reasons. And it may happen all at a time that's not necessarily a good fit for what you need to accomplish. And so I always say, why wouldn't you take calls from key lenders in the marketplace to develop relationships so that if something goes wrong, you've got the next potential lender ready to help you out? Never understood why a CFO, and I know they get a lot of calls.
Right.
But whether it's the risk management insurance people, whether it's the bankers, whether it's the accountants, it always makes sense to have a good bench waiting in the event that you need them. You don't have to talk to everybody, but make sure you're talking to a handful of players in each space so that you've got a backup partner in the event something goes wrong.
Yeah, that's so funny when you were talking about cold calling. I remember my financial guy. I made him call on me for a year. He called on me every single month for a year, and I'd be like, I'm busy, call me back. I'm busy, call me back. And when I finally met him, he was like this 22-year-old child. But he had done the work, and I've been with him for 20 years. Him grow up, get married, have kids, all of that kind of stuff.
Yeah.
And that relationship, and it's funny because the same thing. I have lots of people on LinkedIn reaching out to me for who are financial planners, and it's no, as long as my guy's doing the job. So I think there's some good and bad, but when it comes to the kind of money that you're talking about, I think that is a really good piece of advice to just be open to building those relationships because you don't know what's going to happen in the market.
Yeah, even the money that I deal in, look, at the low end, I'm dealing with companies that need a couple $100,000. And at the upper end, I'm dealing with companies that need $7 to $10 million. So it's still, the lesson is the same for everybody, which is don't put all your eggs in one basket. Make sure that you've got backup, you've got redundancy almost, and you're prepared to make a move and know that you have got a really good, strong relationship with a second and third option in some cases.
Yeah. So, can you share a real world example of how a business might leverage the right financing solution to scale to so that they can solve a major cash flow challenge?
Yeah, I'd love to do that. What I'd like to do is tell you about one of my two clients, which used funding I arranged to catapult onto the Inc. 5000 fastest growing private companies list. So I arranged an asset based line of credit backed by receivables and inventory for a beverage manufacturer. And that helped them grow their revenues from $15 million to over $45 million in less than 4 years. The revolving line of credit tripled in size, and it enabled them to raise less equity than they actually might have needed to, which is very important to shareholders who are counting on an exit. Most recently, for that same company, I arranged a multi-million-dollar sale leaseback of all their critical manufacturing manufacturing equipment. So once again, protecting their shareholders from further dilution, as well as diversifying their lender base, right? So it was a different lender than provided the working capital facility. So it gave them a little bit of diversification so that no one would have complete control over their business.
With everything is just a little crazy right now in this world that we're living in. With the current economic climate that's going on right now in 2025, what are some of the trends that businesses should be aware of when it comes to securing financing?
So interestingly enough, bank loan demand was up in the fourth quarter, 2024, and more deals got done. At the same time, banks were tightening credit underwriting in the fourth quarter. So the key word for banks and lenders in 2025 is uncertainty. And why is that? You've got uncertainty about Trump 2.0. You've got inflationary pressures, interest rate uncertainty. Throw in subpar economic growth, continuing geopolitical shocks, banks that are rebalancing their balance sheets for asset and industry concentrations. You name it. There's a lot of things right now that are keeping bank CEOs anxious and losing sleep at night. So on the flip side of that for 2025 is banks aren't the only game in town. And non-bank lending is an increasing source of funding for businesses of all sizes. There's more absolute dollar amounts of money available. There's more funds and quantity of funds. There's more asset classes they're lending to, more structuring creativity, less regulation, which all points to the non-bank lenders becoming an increasingly larger source of liquidity for growing businesses.
Hmm. And you mentioned that with the credit tightening up and stuff, if a company has had some challenges with their credit, what are some things that they can do to repair it to get those numbers up?
Run their businesses better is the
Yeah,
short answer.
yeah.
But here's how they can run their business better. And I would tell you it's business owner, the chief financial officer, the chief executive officer should really have someone analyze all their financial ratios, because that will tell them how a lender's going to look at them and decide whether or not to extend credit to them, to give them a loan. And if you don't know how the lender is viewing you, then you can't possibly know how to change your business and run it differently in a way that helps you attract capital at a more cost-effective basis. So it really gets down to the numbers and knowing who you are, how you present, and what things that you have the ability to pull the levers on, so to speak, to make changes that make a difference.
Yeah, and those numbers don't lie, no matter.
Numbers don't lie.
So we're covering a lot now. When it comes to business owners who may feel overwhelmed by this whole process, what are some of the first steps or some baby steps that they can take to really start to set themselves up for success?
I usually give 3 steps when somebody asks me that question. And the first is get your financial reporting house in order. Lenders want you to be able to provide them with accurate financial reports in a timely manner. If you can't produce your financial reports in a very short period of time, if they're not available when due, or you simply don't have the ability to extract basic information out of your financial system, that's a problem. That's a real big problem. The second thing is, in addition to being able to look backwards, we want to know what you're going to look like on a forward-looking basis. So I always suggest to my clients that they have a robust 3-statement financial model which forecasts the next year on a monthly basis. And then finally, it's the same thing that we talked about on the last question, which is you need to know who you are. That's the third piece of advice. Know who you are. What are your financial ratios? How do they qualify you to borrow money, and from whom? And with those 3 bits of information, you can really do a much better job in attracting capital with less anxiety on your part as the business owner.
As we're getting to the end of our time together, is there anything that I didn't ask you that you wish that I would have? Or is there any other best practices that we need to cover?
I would say that people ask me how I should run my business. And I always tell them, run the business if you're going to sell it tomorrow. Right? In other words, run it to maximize after-tax cash flow, because that's what's really going to drive value. Revenue's nice. It may make a difference. Net income, it's better to have net income than not. But at the end of the day, it's about after-tax cash flow. And if you always have that at the forefront of your mind in how you run your business, then whether it's for yourself or whether it's for a potential exit, you're going to enhance your value in the best way possible.
Awesome. All right. And if people did want to continue the conversation with you and learn more about what you do, what's the best way for them to get a hold of you?
I would say reach out to me by LinkedIn or via email. And my email is marshall@funding911.com.
Oh, good. Good website address. You must have gotten that early on. Okay.
I've had that for a long time.
Sounds like it. Marshall, thank you so much for joining me today.
My pleasure, and thank you so much for having me.
I'm Lisa Ryan, and this is the Manufacturers Network podcast. We'll see you next time. Thanks for listening to the Manufacturers Network podcast. Do me a favor and share this podcast with your friends and colleagues so we can grow this network and connect more fantastic folks just like you. You can either send your buddies to the website at manufacturers-network.com or share the Manufacturers Network podcast on your LinkedIn, Facebook, Twitter, Instagram, or wherever you and your industry friends hang out. The bigger and faster we grow the network, the stronger and deeper the community we'll all have. Thanks again, and I appreciate you.